Why financing? Through the dealership. Could cost you thousands. Have you ever walked into a dealership, found the perfect car, and then spent hours in the finance office signing paperwork you barely had time to read? Most people think the dealership is helping them get the best loan possible. Sometimes they are, but many times they're helping themselves make more money. Here's what most car buyers don't realize. The dealership isn't usually lending you the money. A bank or credit union is. The dealership acts as the middleman between you and the lender. Let's say a bank approves you for a 6% interest rate. The dealership may be allowed to increase that rate to 8% and keep part of the difference as profit. That means you could be paying hundreds or even thousands of dollars more over the life of the loan without ever knowing it. Now, does that mean dealership financing is always bad? No. Sometimes dealerships run special promotions like 0% financing or manufacturer incentives that can actually beat what a bank offers. But the mistake is walking into the dealership without already knowing what financing you qualify for. That's where credit unions and banks come in. Before you shop for a car, get pre-approved. A pre-approval tells you exactly how much you can borrow, what your interest rate is, and what your monthly payment should roughly look like. Now you walk into the dealership with power. Instead of asking, "Can you get me approved?" you're saying, "I already have financing. Can you beat this rate?" That's a completely different conversation. And when dealerships know you're already approved elsewhere, they often work harder to find a better deal because now they're competing for your business. Credit unions are especially worth checking. Many credit unions offer lower interest rates than traditional banks because they're member-owned organizations rather than profit-driven corporations. Even a difference of just 2% or 3% on a car loan can save you thousands over 5 or 6 years. Let's look at a simple example. Imagine financing $30,000 for 72 months. At 9% interest, you'll pay significantly more than you would at 6%. The monthly payment might not look dramatically different, but the total amount paid over time can be thousands higher. And that's money that could have stayed in your savings account, gone toward investing, paid down debt, or funded a family vacation. Another advantage of getting financing first is that it helps prevent payment manipulation. Dealerships love asking one question: what monthly payment are you trying to stay under? The problem is that focusing only on the monthly payment can hide a longer loan term, a higher interest rate, or extra products being added into the loan. Instead of negotiating the payment, negotiate the total price of the vehicle and compare financing options separately. That's how smart buyers shop. So here's the wise owl takeaway. Before you ever step foot on a dealership lot, check with your bank and at least one credit union. Get pre-approved. Know your interest rate, know your budget. Then let the dealership compete for your business instead of relying on them to tell you what's best. Because when it comes to financing a vehicle, the smartest deal isn't always the one sitting in the showroom. Sometimes it's the one you secured before you ever got there. Follow Wise Owl Wealth for more financial tips that help you keep more of the money you work hard to earn.